All right, I think we can go ahead and get started. For those of you attending, just a reminder that this is the Business Valuation 101 course for attorneys, and it's an overview of business valuation basics to help you guys, the attorneys, and your clients. Just a couple of quick housekeeping things before we turn it over to Edward. You are muted right now, so we ask that you submit your questions in the Q&A box. It's at the bottom bar, so you'll see a chat box and a Q&A. If you throw it into the Q&A box, it's easier for us to be able to field those questions, so please try to use that. CLE will be provided within a week of the webinar, and I believe all of you did submit your bar numbers. If you didn't or think that you might not have, go ahead and email marketing@bvccpa.com. It's right there on the screen for you. We will send these slides out after this presentation concludes. This is the last one of our Back to School CLE series, so you'll see that in your inbox. And then recordings of this event and the other two events, the Accounting 101 as well as the ransomware presentation, will be sent out later this month, so you'll be able to access this presentation, and I believe you'll also have access to the other two even if you didn't attend. Don't quote me on that, but I'm pretty sure that's the plan. So I'll go ahead and hand it over to Edward. He'll give you guys the scoop on who he is, and then he'll jump right into the presentation. So Edward, it's all yours.
Okay, Ashley, thank you so much, and everybody, thank you very much for attending, spending an hour with us here today. As Ashley said, my name is Edward Fowler. I'm a partner in the Financial Valuation Litigation Support section of Briggs Veselka. I got a finance degree and an MBA, started my career with what was Big 8 accounting, now Big 4 accounting, doing business systems consulting and valuation work. Did some investment banking for a few years and started my own valuation firm about 23, almost 24 years ago. And then I ended up selling to Briggs Veselka in 2019. So I've been a partner with them since then. So been at it for a while, about 30 years, testified in both state and federal court on a number of different matters, marital dissolution, bankruptcy, obviously valuations, stock option, dissenters' rights. I can't say, actually, I know I've testified in all of those matters, and most of them have been actually in the courtroom. So I appreciate everybody being here, and I will encourage anybody who has a question, please submit it at any time. I'd like to keep this as, back and forth if we can. I'll get tired of hearing myself talk after a while, so let's get going. What we're going to go over today is why people need business valuations, the definitions of value. There's various definitions of value that we use, revenue ruling 5960, some of the factors you consider when doing a business valuation. We'll talk about some of the basics of the financial analysis we do, go over the major valuation approaches and kind of take you through an example of valuation, talk about some of the adjustments for marketability and control that we apply in doing valuations. And then being here in Austin, we do a lot of venture capital or hardware, software type related valuations or companies that we value, and they often have preferred stocks. We're going to go over some of the preferred stock features, and I find those interesting because they really can affect to a large degree the value of the particular security you're valuing, which is often common stock. And then hopefully we have some time left over for questions, but please submit questions as we go along if you have any. So the reasons for business valuation, mergers, acquisitions, people want to know what their company is worth. Fairness opinions, sometimes the board of directors gets an offer to buy a company and they want to have an outside financial expert opine as to if it's fair from my financial point of view. Buy-sell agreements, shareholder transactions, employee stock ownership plans. That's one of the few recurring revenue jobs we have is Department of Labor requires evaluation for an ESOP shares on an annual basis. We do a lot of work for gifts and estate tax planning or reporting. We value stock options, or when a company is going to issue stock options, they want to know what price they should set the strike price at, and they want to do that at fair market value so that there's not a tax consequence of issuing the option to the employee. We do some valuation work for financial reporting. When a company acquires another company and they're using GAAP accounting, they're charged with putting the acquired assets on their balance sheet at fair value. So Cash will be cash, machinery equipment will be machinery equipment. We don't value those things, but we can value the intangible assets, the trademarks, trade names, the patents, the assembled workforce, and then everything that's not put into a particular asset classification goes to goodwill. And then you may have goodwill impairment testing. So you'll do an annual impairment testing, see if the company as a whole is, you need to make adjustments to the value of the goodwill you posted on your balance sheet. We also do a lot of litigation support work, and that leads to that testimony that we do. So we do litigation support on matters that involve lost profits or damages, marital dissolutions. When a couple owns a business and they're getting divorced, they've got to split up the marital assets, and that involves evaluation often. Shareholder disputes, or business divorces. Shareholder A may get upset with shareholder B, trigger the buy-sell agreement, and therefore they need evaluation. There's lots of different terms that go with that. And then, of course, dissenter's rights. So if a corporation decides to make a certain election to either sell or raise additional money, some shareholder may dissent to that action, and they have rights through the courts to actually perfect their dissenter's rights and get bought out at fair value, and that may require evaluation. So there's multiple different definitions of value. The most common one is fair market value, which is the price expressed in terms of cash equivalents at which property would change hands between a hypothetical willing and able buyer and hypothetical willing and able seller acting at arm's length in an open and unrestricted market when neither is under compulsion to buy or sell, and when both have reasonable knowledge of the relevant facts. And as I said, it's the most commonly used definition of value. It does assume a hypothetical willing buyer and willing seller, not a particular willing buyer, willing seller, so kind of a man from the street, and assumes that, prevailing economic conditions at the time of the valuation. So it's really more of a financial valuation. Somebody's buying this business or business interest for a rate of return, which can be distinguished between fair market value and the next definition, which is investment value, which can be the value to a particular investor based on that individual investment requirements or expectations. So under investment value, you may have synergistic savings or strategic value that wouldn't necessarily be incorporated into fair market value, which is a hypothetical man from the street, person from the street. You have fair value when we do that financial reporting. When those assets are put on the balance sheet, the definition of value is fair value, the price it would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. To me, is pretty synonymous to fair market value. And there is another definition of fair value, which relates to the dissenter's rights claims, mostly either dissenter's rights or maybe some shareholder repression acts. But it's statutory definition, and it varies by states. And it's defined under the Texas Business Organization Code in subsection 10.362B. And it says, fair value, in computing the fair value of an ownership interest under the subchapter, consideration must be given to the value of the domestic entity as a going concern without including in the computation of value any control premium, any minority ownership discount, or any discount for lack of marketability. It goes on to say if the domestic entity has different classes or series of ownership interest, the relative rights and preferences of the limitations placed on the class or series of ownership interest, other than relative voting rights held by the dissenter, must be taken into account. So if you have a preferred share, you need to respect the terms that preferred stock, but for voting rights. And with the 2 points to go along with this is the valuation date is the date preceding the action to which is the subject of the appraisal. So it doesn't include what is going to happen to the value of this business going forward because of the proposed sale of the business or what occurred that the shareholders dissented to should not be taken into account in the valuation. And it also excludes any appreciation or depreciation in value due to the opposed action. So it's a value as it exists on that date without any control premiums or minority interest premiums or discounts, and without taking into account the matter that got dissented to. And the last definition of value is intrinsic value. And this definition is the inherent value of a thing without any special features that might alter its market value. And the example is, the intrinsic value of a silver coin is the value of the silver in it. The only time I've seen intrinsic value references in connection with the dissenter's rights case, and I think from that perspective, it's the value of the interest that you're valuing with, without any discounts. It's a pro rata share of the whole and not distorted by the events that this shareholder is dissenting to. So the true value of what you're opposing, and you should be bought out at the true value. So the things we consider when doing a business valuation, revenue ruling 5960 has been out for a long time, but it's really held up in the over time, and it discusses 8 factors you ought to consider. But there's a little bit of a preamble to it, which is, I love this, a sound valuation. Just go back one. The sound valuation will be based on all the relevant facts. So it's fact driven, but the elements of common sense, informed judgment, and reasonableness must enter into the process of weighing those facts and determining their aggregate significance. I totally agree. It is a financial exercise, but you have to use that common sense and informed judgment and say, how does this apply to the facts in the case in this matter to impact value? And revenue ruling 5960 lists 8 items that ought to be considered in any business valuation, which are the history and nature of the business, the economic outlook for the company, as well as the specific industry, the book value of the interest and financial condition of the business, its earning capacity, its dividend paying capacity, the value of intangible assets such as goodwill, prior sales of the firm's stock, and market value of other firms which are traded in an actively traded in a free and open market. Other things we always consider are the form of the business organization. Is it a corporation? And if it's a corporation, is it an S Corp or a C Corp? Is it a partnership or LLC? The seasonal or cyclical factors that may impact the business. Obviously, what types of products or services it's providing, competition, geographic diversification, are there barriers to entry, the management team, major assets, regulatory considerations. You may have contingencies. There may be a lawsuit outstanding. You may have off-balance sheet assets, off-balance sheet liabilities. You want to make sure you at least consider those items. And there's another way to look at a business, kind of to frame it within its own ecosystem, this Porter's 5 forces, the bargaining power of buyers. So the buyers, the suppliers, competitors. Are there any substitute products? That happens a lot in technology, where you may have a product that the technology advances and all of a sudden you're become obsolete and a substitute product came in and took over because it was a better mousetrap. And then the threats of new entrants, that barriers to entry again. So some of the base financial analysis we do, we start off with studying the company's balance sheet in terms of dollars, and we'll do a common size balance sheet analysis in terms of percentages. Same thing with the income statement. We'll spread the historical income statement and get it down to cash flow. We'll common size it, and then we'll look at financial ratios and statistics of the particular company, and we'll compare that to other comparable businesses or companies and businesses in the same industry, the same revenue size. So the balance sheet analysis, we'll go back, typically go back 5 years and spread the financials. Here we have, the balance sheet spread from 2014 through 2019. And then we'll common size it, where we'll take that balance sheet and we'll convert it to percentage terms, where total assets is 100%, total liabilities and equity is 100%, and then go look at the different line items, see how much they make up of the asset side of the balance sheet, or the liability balance of the side of the balance sheet, and of course, what percentage is equity in the business. So we'll do that. We'll common size the balance sheet. We'll spread the historical income statements, and obviously starts with sales and gross profit. Operating expenses gets down to EBITDA, all the way down to net income, and then we'll take net income and we'll convert it to cash flow. So net income's obviously very relevant, but it's an accounting measure, and it's not the true cash flow that the business owner can take home at the end of the day. And a lot of the work we do is looking through the accounting to get down to cash flow. Cash flow, cash flow, cash flow. We'll common size the income statement. Again, where total sales is 100%, and we'll look at what's the cost of goods sold, what's the gross margin, gross profit percentage, how much is operating expenses as a percentage of sales, what's our EBITDA margin, all the way down to net income, and again, through the items to adjust to get to cash flow. And we'll do ratio analysis, where we'll take the historical balance sheet and income statement and calculate ratios. And we usually look at a set of profitability ratios, which is return on assets, return on equity, again, gross profit margin, EBITDA margin, all the way down to pre-tax profit margin. We'll look at owner's compensation as a percentage of sales. That's one of the more typical adjustments we may make, because if an individual or a group of individuals owns a privately held company, they may have different compensation structures, so we may adjust the compensation. We look at liquidity ratios, we look at activity ratios, turnover ratios, and we look at leverage ratios. And then if you look at the far right column of this slide, it says peer group. And that's a peer group where we get industry ratios of similarly sized businesses. And you'll see it's defined down at the bottom left. The peer group is comprised of XYZ businesses within this industry code with sales of greater than 25 million. So we'll compare our company's profitability ratios to similarly sized businesses in the same industry. Same with liquidity ratios and the activity ratios, et cetera. And where do we get our peer group data? Well, we subscribe to the RMA, or Risk Management Association. They publish all the industry statistics and ratios, and we can go out to their database and pull in information. IBIS World, we get the industry reports. They also have some industry statistics and ratios. And then, of course, you can go to the public guideline. You can go to actively traded public companies from Yahoo Finance or somewhere and see what some of those specific companies' margins are and profitability is, et cetera. So, valuation approaches. There are 3 commonly accepted valuation.
Can I stop you right here for a question?
Oh, yeah, please.
I should have stopped a little while ago. This is kind of around 409A and setting profit interest hurdles.
Okay.
Kind of a tax question, so we might not have the direct answer, but the question reads, can incorrectly or prematurely setting a profit interest hurdle for profit interest holders to incentivize employees in an LLC inadvertently trigger tax basis or valuation implications down the road to the original founder? So it's
I'm not sure to the original founder, but it may impact the employees who receive those interests.
Yeah, so.
Because there will be a tax consequence where the IRS may come back and say, no, I'm sorry, you were issued stock options or profit interest at below fair market value, so you receive some compensation. They may call that a compensation issue, and they may tax them as compensation.
Perfect. Well, we can move on to valuation approaches.
Okay. Let me know if that didn't answer the question, please. Let's go hit the valuation approaches. There are 3 generally accepted valuation approaches: the income approach, the market approach, and the asset approach. The income approach measures the present value of expected future economic benefits, and again, typically measured as cash flow. The market approach is looking at prices at what interest in the subject businesses actually traded for, or what interest in comparable businesses have traded for. And then the asset approach, the fair market value of the assets of the company less the fair market value of the liabilities equals net asset value, and an indication of the value of the equity of the business. So under the income approach, again, we try to get down to cash flow. And we usually start with net income, and then we'll add back non-cash and depreciation amortization expenses. We'll take out the capital expenditures, which is the actual cash outflow that is later depreciated on the income statement. We'll look at changes in working capital. And then if we're going to measure cash flow in terms of cash flow to equity, we'll take out changes in debt. So your interest expense is deducted on the income statement, but if you take out the changes in debt, you're going to end up with a cash flow to equity, which is different from a cash flow to invested capital, where we start with net income add back non-cash depreciation and amortization, subtract actual cash capital expenditures. We'll incorporate changes in working capital, but then we'll add back after-tax interest expense. And that gets you down to a free cash flow to invested capital, which is used to value the company's invested capital, both its debt and equity. So that free cash flow to invested capital is a cash flow that's needed to satisfy both your banker and your shareholders. So it's the value of the debt and the equity of the business. And if you want to get down to the value of the equity using this measurement, you need to go ahead and subtract the debt at the end to get to the value of the equity. So, and how do we convert these future cash flows or the projected cash flows to value? We usually use a required rate of return. So the whole income approach is, what are the expected future cash flows from me buying into this investment? And what type of rate of return do I want, considering the riskiness of that investment and how certain I am those future cash flows are going to be received and at what amounts? So, and how do we do that? We use a required rate of return on that investment. And it's used to convert those projected or discount those future values to present value. And the higher the risk, the higher rate of return or the higher discount rate. And there's two general methods we use. One is a build-up method, and then there's also the capital asset pricing model or the CAPM method. The build-up method, as described, you start with a risk-free rate of return, and you'll add on specific risk premiums to get down to an overall total rate of return you would want on your investment in that business. So we start with typically a treasury yield considered to be the risk-free rate of return. We'll add an equity risk premium. We'll add an industry risk adjustment, and a lot of businesses we value are smaller type businesses, so we'll typically add a small company risk premium. And then you'll add a specific company risk premium. So the treasury yield, the equity risk premium, the industry risk adjustment, the small company risk premium, that's industry data or market data that we can get. We usually get that through Duff & Phelps. And the specific company risks are risks that are specific to that business, such as a high customer concentration issue. If they have one customer that is 90% of their sales, well, that's a special risk that is specific to that company. So we'll add a specific risk premium for that. You add up those different components, you get an overall rate of return. And that would be a rate of return on equity, and that would be to value the equity cash flows. And if you're looking at a cash flow to invested capital, you'll need to look at the rate of return on both the equity and the rate of return on the debt, and how much debt and equity makes up the capital structure of this business. So on the previous slide, we came up with a return on equity of 20. And now we're going to introduce how much debt do we have, what's our interest rate. You get a tax savings on the debt. So as described, you do a weighted average of the cost of the debt and the percentage of debt of the capital structure. What's the cost of the equity and the percentage of the capital structure? Overall weighted average cost of capital. And that's a discount rate. And then to convert that to a capitalization rate, on the bottom of the slide, you'll see we'll subtract the long-term growth rate to get to a capitalization rate. So what type of rate of return do I want over time? And if you're going to use a single period capitalization, or you got to take out the long-term growth rate to get to cap rate. The capital asset pricing model is different, and it measures risk by the term beta, and beta is volatility. So capital asset pricing model is the expected rate of return on the investment, E sub RI. Then you start with the risk-free rate, beta, and then the return on the market less the risk-free rate. So if you look at this formula, it's really very similar to the build-up method, where you have the risk-free rate of return plus beta, which is a riskiness of that investment relative to the market, which is kind of synonymous to an industry risk adjustment. Then you have the rate of return on the market less the risk-free rate, which is the equity risk premium. So it's really the very similar concepts to the build-up method. Is just looking at it from a more public market perspective. And where do we get our rate of return information, discount rate? As I said, we subscribe to Duff & Phelps. We get a lot of the industry information there. Yahoo Finance has betas. Federal Reserve has treasury yields. And then if we're valuing a startup company or venture capital backed company, there's studies regarding the rates of return there. So how do we apply the income approach? Well, we came up with our cash flows and we had projected cash flows. And here we have a projected cash flow to invested capital. And that's spread out over time. We have cash flows for the next 4 years, 2020 through 2023. And we'll bring those back to present value by multiplying them times a discount factor based on our required rate of return. So in this case, we have present value cash flows for the year 2020 through 2023, and that totals 3.552 million. Then we'll take what's the value of this business, all the future cash flows after the year 2023. Well, we'll take that future cash flow, we'll grow it, and then we'll capitalize it, dividing it by that capitalization rate, which is the discount rate less that long-term growth rate. And that gets us to the value of all the future cash flows of the company at the end of 2023. So we have to bring that back to present value. The value of all the cash flows after the year 2023 was found to be 5.85 million. So the total value of all the cash flows is 9.4 million. We were valuing 100% of this business, so we're going to take a little discount for lack of marketability because it's privately held, make any working capital adjustments, and we get down to the fair market value of this company's stock of $8.46 million. That was the income approach. We move on to the market approach. Again, you may have recent arm's length transactions involving the actual stock of the company you're valuing. And we've had those situations recently where we had some venture capital backed companies and they were doing really well. So they sold some preferred stock and it was oversubscribed. So people said, I want this stock. They were willing to go out and buy common stock at the same price. Well, the valuation we were doing was for one of the founders was, putting some stock and some trust for their family. And we had actual transactions in the common stock and he was transferring common stock to these trusts. So we had a very strong indication of value. We also look at, what have actively traded publicly traded companies traded for. So the public guideline company method. And then we also subscribe to merger and acquisition databases. And we have a merger and acquisition, private company merger and acquisition data method. So the public guideline company method, as described, we're utilizing information in regard to the prices at which shares of similar publicly traded companies have traded to value a privately held company. And we'll look at pricing multiples. So we'll look at what are these publicly traded companies trading in terms of price to revenues, price to gross profit, price to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It's kind of a common metric used in valuation. Price to EBIT, which is price to earnings before interest and taxes, price to earnings, and of course, price to cash flow. And then there's the merger and acquisition data method. So we, again, subscribe to merger and acquisition databases that list sales of transactions of businesses. And there's 3 databases we subscribe to: DealStats, which involves the acquisition of privately held companies. BizComps also involves the acquisition of privately held companies, but typically more mom and pop type businesses. And then MergerStat, which involves transactions and acquisitions of publicly traded companies. So here's a screenshot from a transaction what we found in DealStats. And if you can see, kind of midway down on the left, they give you some income statement data. On the top, it describes the business. A lot of times you don't get the name because these are privately held companies, but it'll tell you what industry it is and when did it sell, number of employees, et cetera. And then you have some income statement data. You have some balance sheet data. And if we flip over to the next page, it'll give you some margins and statistics on it, a little bit of additional notes. And then on the left-hand side, in the middle, you have valuation multiples. And that's actually what this business sold for in terms of price to sales. And it's MVIC, market value of invested capital, as a percentage of sales or a multiple of equity, EBITDA, earnings before interest, taxes, depreciation, amortization. So this business sold for 29% of sales, 57% of gross profit, 6.6 times EBITDA, and about 3 times discretionary earnings. So we'll use these metrics to try to come up to a value of the business we're valuing. So we go out to the database, we'll do a query. So we want businesses within this industry, within this revenue size range, within this state range, and we'll find a list of comparable transactions. And then if you look through the columns, if you can see them, you have the sale date of the sale, what are the revenues? We can look at some profitability metrics, what's the gross profit margins, the EBITDA margins, and then you look on the last three columns to the right, you have multiples. So you have a price to sales, MBIC to sales. What price to sales did this company sell for? Or a price to gross profit, or a price to EBIT. And then we'll go down, we'll look at the high, low, median, average. We'll select multiples, apply them to our company's actual financial results to come up to preliminary indications of value. Then based on the quality and the quantity of the information we're relying upon, we'll weight those, total them, add any additional balance sheet adjustments to get down to a fair market value of the equity of that business. So a couple of interesting metrics in the market approach, seller's discretionary earnings. So we talked about EBITDA. There's another metric that kind of applies to more mom and pop type businesses. So it's how much money or cash flow an owner of a company earns from owning and operating that business. I look at it as somewhat of a payback period. If I want to buy a business and I'm going to own it and I'm going to work there, I'm buying myself this job and operate it, how many years I'm going to work there before I get my money back? Kind of a payback period on the buying, owning, and operating a business. And that's, those multiples are shown and commonly used in both DealStats and BizComps. And it's measured as a pre-tax earnings because the company could be a flow through, it could be a C Corp where it's taxed at the corporate level. You're adding back that non-cash depreciation and amortization because they may or may not have capital expenditures. It's a non-cash expense. You're going to add back interest expense because may or may not have to have debt. And then you're going to add back that owner's compensation. So it's the profits of the company on a cash basis before debt, plus my compensation. How much money am I going to be able to take home by owning and operating this business? And then, therefore, how many years do I have to own it and operate it before I get my purchase price back? So using the income approach, we came up with a value on using a discounted cash flow method of about 8.4 million. We had two indications of value using the market approach, one from DealStats, use asset sales, one from DealStats stock sales, came up with 12 million, $11 million. We weight those based on we think is the strongest indications of value, and then we sum them to get to a total value. In this case, value of 100% of the shares of this business, $10.25 million. Any questions?
We don't have any in the queue.
All right. Well, here we came up with the value of 100% of the shares of this privately held company. And oftentimes when we're using the different methods, we need to make adjustments to get down to the actual interest we may be valuing. We may not be valuing a controlling interest. We may be valuing a minority interest. And typically we're valuing privately held companies. So there is no market for them. So we may have adjustments for marketability and control. And depending upon what method you use, you come up with a different indication of value. So if you're using an income approach and you're using discount rates or rate of return information from the public markets, that build-up method or that CAPM, capital asset pricing model, you're going to come up with you're using a discount rate or a required rate of return that incorporates the ability to get online and sell your stock and get your money back in 3 days. If you buy a privately held company, you can't log onto your computer, sell your stock and get your money in 3 days. So there's a difference in those, and it's marketability. So income approach, rates of return from the public markets, you're going to get a marketable indication of value. Using the market approach, again, if you're using public guideline companies, you're measuring the value of a company that has traded in minority blocks, and you get your money back in 3 days. So you have a minority marketable indication of value. And then if you're using transactions from private, sales of privately held companies, well, that's a sale of 100% of a privately held business. You're going to come up with a control non-marketable indication of value. So you may have different indications of value relative to marketability and control, and you may need to adjust to get down to the specific interest you're valuing. And then so you may have a controlling interest and you can take a control premium, or you may be able to apply a minority interest discount. Conversely, you may have using marketable indication of value, you may need to take a marketability discount. So you can kind of go up and down this levels of value to say, do I need to apply a control premium? Do I need to apply a minority interest discount? Marketability discounts, which can range based on facts and circumstances, but how much are they typically? There's a lot of pre-IPO studies that suggest discounts of about 45% for marketability. There's restricted stock studies, a lot of empirical data on those that suggest holding periods of greater than 2 years, discounts average around 35%. Restricted stock studies, when the holding periods are less than 2 years, can range from 10% to 25%. But at the end of the day, it does depend on the nature of the company and the interest you're valuing. So the things we like to consider, and some of these are laid out in the Mandelbaum decision, is, are we valuing a controlling or a minority interest? It may be easier to sell the controlling interest. And certainly if you have a controlling interest, you can declare dividends. If you're a minority interest, there may be not as much market for it, and you cannot declare a dividend, so you have a liquidity issue. Are there any restrictions on the transferability of that interest? A lot of times partnership interests, limited partnership agreements, or LLC company agreements have restrictions on transferability. Are there prospects for a sale of the company in the near future? Is the company for sale, or is it prospect for an IPO? Is there a liquidity event upcoming? What's the dividend paying capacity? Is this company paid dividends in the past, or are they planning to pay dividends in the future? A lot of times, if you buy a small privately held, a minority interest in a privately held company, you may not ever get any money from it. In fact, you might even get a tax bill passed through to you without a money to pay the taxes. So how long are you expected to hold this investment? Does the company have a redemption policy? Will they buy your shares back from you? Do they have put rights? Do you have the right to sell the shares back to the company? And of course, what's the desirability of the company, of the industry? Do you have access to information? There may be certain restrictions on your right to get information, which can inhibit your ability to come up with a good valuation and find a good buyer for it. And then, of course, the quality and consistency of the financial information. If it's bad records, people may be turned off by that, harder to find a buyer. So minority interest discounts and control premiums. The applicability depends on the characteristics of the subject interest we're valuing. And a lot of that has to do with the size of the interest we're valuing. Are we valuing 100% of the business? No other shareholders? You can do what you want. Valued a company one time and one shareholder, and he said, yep, I have one member of the board of directors that keeps the meetings real easy. So you have absolute control to do anything you need to, obviously within the law. You may have a super majority, which in Texas is greater than 2/3. You may have a simple majority, which is greater than 50%, but less than 2/3. Then you may have a simple minority interest, less than 50%. You really can't do anything other than possibly vote. You may have stakeholder agreements that can affect the ability to make control adjustments, such as a limited partner can't make any changes. And then you may have voting rights. Voting rights versus non-voting rights, and then of course swing blocks. And where did we get our data for minority interest discounts and control premiums? MergerStat publishes a book that does control premiums by industry. And there's also the MergerStat BVR control premium study database. They put out a database. We use one for both pricing metrics and the market approach, and also they actually show premiums that are paid for acquisitions. So when a publicly traded company is acquired or is taken public, or is taken private, the buyer will typically pay a premium over the minority interest share price that's actively traded in the market, so they can induce people to sell their shares. A lot of times that's for the ability to actually control the company and improve its cash flows. So this is some of the data that MergerStat puts out in the MergerStat publication. They'll have different industry breakdowns, and they'll say how much were the acquisition premiums paid by year by industry. So we take this acquisition premium and we can convert that to a minority interest discount by using this formula. And then the MergerStat BVR control premium study. This is a screenshot from that database. And if you'll see in the middle of this slide, you have premiums, which is the actual control premium paid or acquisition premium paid. And they'll take that and convert that to a discount, the implied minority interest discount. So this company sold for a 35.9% premium over its actually traded minority interest share price for the acquisition. And then that implied minority discount using that formula is 26.4%. And if you look on the right side of this slide, you'll see again some of the pricing metrics, the target pricing multiples. You got the price to sales, a price to income, a price to book value, price to EBIT, and then of course price to EBITDA. And then, as I referred to earlier,
Edward, let me stop you real quick.
Sure.
So this isn't a question, but I just wanted you to add some color because I think it'd be beneficial to the audience. So the valuation methodologies, it's laid out, income, market, asset-based approaches. But whenever you're doing a valuation, where do you normally see discrepancies compared to, say, another party value in the same company?
That can be all over the place. And you see that a lot of times in litigation where different valuation experts may have different opinion regarding growth rates, discount rates, marketability adjustments, control premiums. It's hard to say where specific differences can occur. I like to think that, good, solid financial analysis should lead to good, solid, defendable valuation results. But every single transaction occurs because of a difference in opinion of value. And that may be the shares of a stock of a company, it may be a car, it may be a home. It transacts because there's difference of opinions and value or what people need versus what they don't need. So it's hard to pinpoint specific areas, but those are some of them.
Would you say that discounts for marketability and control are some of the more subjective areas of valuation?
If you're relying on good, solid empirical data, they shouldn't be that subjective. I mean, there's a lot of different decisions that go into a business valuation. And I think that's the art versus the science of valuation. It goes back to what 5960 said. You take the facts, but you got to use common sense and informed judgment and say, how do these facts apply and affect the value of this business? And it's not just dollars and cents and balance sheets and income statements. It's management. It's the industry. It's the markets. It's growth prospects. And then you get down to the specific security you're valuing and go, okay, do I have restrictions on marketability or transferability? Do I have any ability to control this investment? Do I trust the management team? Do they pay dividends? So you've got to take the facts and then take the bigger picture and all the different influences, and you look at it from those 4 or 5 forces. What's the ecosystem for this business and this investment? So I like to think that good, solid financial analysis and good common sense should come up with good common values. But there's a lot of decisions that go into that, and there can be differences.
Good deal. All right. Preferred stock features.
Preferred stock features. We value a lot of hardware, software companies, startups, companies, and they typically raise money by selling preferred stock, which can have a material impact. You have come up with the value of the equity of the business, 100% of the value of the equity of the business. And you have to take that equity, value that equity, and allocate it to the different stakeholders in the business. And of course, that may be debt, you pay your debt, but then you're left the value of the equity. Preferred shares are different from common shares. And some of the more interesting features to preferred stock are redemption rights. They may have the preferred shareholder may have the right to sell their shares back to the company for what they paid for them. So it actually is more like a bond where you have a set dollar amount you're going to get back at the end of your investment period plus a rate of return, kind of like debt or kind of like a bond. You may have liquidation rights. If the company fails or has a liquidity event, you have the right to get your money back, typically what you paid for your investment, before somebody else does, before the common shareholders do. You may have participation rights where you get a preferred dividend or preferred rate of return. You may have unusual voting rights or board representation. A lot of times if you buy enough preferred stock, you get a seat on the board of directors. You may have take-along provisions, which provides an exit for the investor group if management is offered the opportunity to sell. So management comes in, somebody comes in and says, I want to buy your stock. If everybody has the right to go along on that transaction. They may get registration rights, which is the right to have the company actually register your shares for sale. And then some of the more features that I like are the conversion rights. Oftentimes preferred stock is convertible into common stock. So you have all the downside protections of preferred stock, such as liquidation rights, redemption rights, but you also have the right to convert that preferred share into a common stock and then enjoy all the upside potential and appreciation. And also, if you may have anti-dilution rights, which provides a favorable exchange rate. So if they went out and sell stock in the future at a price lower than you paid for it, you have the right to adjust your conversion rate into common stock to get more common shares because they sold stock later at a lower price. And you may have preemptive rights, which is the right to maintain your ownership percentage in the business should they sell additional shares in the future. So those are some of the features of preferred stock versus common stock and how you go through the waterfall to get down to, in the case of 409A, you typically valuing common stock because they're going to issue stock options that are to buy common stock. So you've got to go through the waterfall to come up with the value of the equity, allocate it to all the different stakeholders, shareholders, to get down to this particular security you're valuing. That is the end of my presentation, and I would love any questions if anybody has any.
And Edward, while we're waiting to see if anyone has any questions, I'll just let the audience know. You'll notice there's 2 upcoming CLE events. October is Cybersecurity Awareness Month. So we just want to let you guys know about a couple of events that we're holding. One is a fireside chat with our CIO and our Director of Cybersecurity. They're going to talk about using data to support your cyber and IT strategies. Sometimes it can be hard to talk to a leadership team member about why you invest in something as proactive as cybersecurity and IT tend to be. And that's on the 13th. And on the 26th, we have a presentation about ransomware, which is a huge topic right now. So even if you don't necessarily work in a cyberspace, it is really interesting just to hear the risks and some of the financial ramifications of what can go on with ransomware, whether that helps you at your own firm or you can help your clients become more secure with their data strategies. So just want to throw that out there in case anyone has any interest. You can find both of those events on the events page on our Briggs and Veselka website, same place that you registered for this event. Mitchell, I'll let you handle the questions part of it.
Yeah, absolutely. So I think, the only question we had that come in was about the profit interest hurdle.
Okay.
I don't think we have any more in the queue right now.
Well, then I want to say thank you all very much for spending an hour with us. Hope you found it helpful. Ashley will make this presentation available to anybody who wants it. And thank you so much. Enjoy the rest of your day.